Welcome to the ETF Market Insights, your regular webinar series that focuses on the evolving world of ETF investing. Each Friday, a new panel of thought leaders aims to provide investment education and insights with the goal of helping you become an informed investor. Make sure to visit www.youtube.com/ETF Market Insights to watch previous episodes, and remember to hit subscribe so you receive a notification when we post new content. Thank you for joining us today. Let's get started.
Good afternoon. I'm Danielle Nezel with BMO Exchange Traded Funds, and this is a special edition of the ETF Market Insights webinar. Today, we want to talk about the impact of the invasion of Ukraine, this impact on markets, on the economy, and on our investment portfolios, all from the lens of a Canadian investor. And I do know this crisis is impacting so much more than our investments right now. Many of our family and our friends and our audience members are personally impacted by this. We just want to acknowledge that too before we get started. Now, this is our disclaimer slide. So a reminder to our audience today, we're not providing any advice. We're not providing any recommendations today. We're here to provide investment education to Canadian investors so they have all the tools and all the information they need to be informed investors and to confidently manage their portfolios. Our expert panel today, well, we got a good one. So we have Jennifer Lee joining us. She's a senior economist from BMO Capital Markets. She's going to give us a top-down view of the situation from an economist's perspective. And Chris McHaney, portfolio manager for BMO ETFs. Chris is here. He's going to provide more of a bottom-up view of how things are looking in terms of different asset classes and how things are specifically impacting Canadian listed ETFs. Well, our 1-minute ETF update today, I thought this information was fairly interesting. So we're looking at commodity and resource equity ETFs and the flows we're seeing into them. And what we've noticed that quarter to date, commodity ETFs like gold, so the red bar here on the far right side, and energy equities, which is the green part of this bar, are seeing a lot more interest from investors as these two sectors are starting to pick up a bit of steam in this macroeconomic environment. And just another proof point how sector ETFs can be used very efficiently by investors to pinpoint a specific sector, to benefit from its tailwinds and easily get into that kind of exposure. So let's jump right into the main event, the main conversation today. So Jennifer, I'm gonna turn to you first, and I'm gonna ask you, and I know this is a big question and we don't have answers for these types of things yet, but just from your perspective and how you're seeing things play out right now today, how long is this war going to last? And what are you and your team thinking about its spread? Could it spread beyond the Ukraine?
Well, you know, that's the trillion ruble question these days, although that doesn't obviously count for much anymore with the ruble at record lows. But I think even the most seasoned, the most highly intelligent political pundit out there doesn't know, nor do I think that President Putin himself knows. I think the worst case remains. You've got the Russians taking over Kiev, maybe installing a puppet government and then moving west, going beyond Ukraine, which obviously would be horrible. And that would invoke Article 5 of NATO, which hasn't been done since 9/11. There are a number of other different outcomes that could happen. You could take over Kiev and just stop there. Putin's soldiers could stop listening to him. Putin could call it all off due to the pain caused by sanctions, or it just might involve securing another part of Ukraine and then backing off, as you know, Russia is crushed by all the sanctions that the free world is piling on. So, but I do have to say that you know, Ukraine's got this new urgent quest for EU membership now, and that's probably going to irk Russia even more, and it's definitely no guarantee that they're going to get in. Even with President Zelensky, his impassioned plea to European Parliament to prove that you are with us and prove that you won't let us go. I don't know if the European Council is going to want to move them to the front of the line and bypass a bunch of the other countries that are still in the running. So, Danielle, in short, I don't have an answer. All possibilities are available, but I will cling to the fact that at least both sides continue to talk, and a third round is reportedly coming next week.
Yeah, really interesting to hear about developments with the EU, and will they bring the Ukraine in, because that changes the game entirely by making this a war not just with Ukraine but with the entire European Union. So we will monitor that. Now, Jennifer, I know inflation's been very talked about and top of mind all year, but now that we're seeing this war unfold, how has that changed inflation expectations, or how has it impacted them?
The short answer to that is that we're gonna see inflation headed even higher, like higher than they are already. You know, we've already had, everyone knows this very well, the supply chain disruptions. They pushed inflation higher. We've got 30-year highs right now of inflation here in Canada, 40-year highs in the US. And this war is just going to make things worse. The first factor right away is on the energy front. And even before the official attack last week, we were already on the up and up just on the prospect of the war. Fed Chair Powell actually said in his testimony to the Senate Banking Committee on March 3rd that a good rule of thumb was that for every $10 rise in oil, it adds about 0.2 to inflation. Here at BMO Economics, we've got a slightly different take. For every $10 rise in oil, we see that it boosts the headline inflation rate in both Canada and US by about 0.4 of a percentage point. So that is the first factor on the energy front. Another factor is on food. You've got Russia being the world's biggest supplier of wheat, and with the Ukraine, both of them account for about a quarter of total exports. So this will impact their buyers like Egypt and Turkey. And both of them take in about 70% of wheat imports. So those, I think, are the direct implications. You've got a lot of indirect implications as well, you know, basically messing up supplies. So I feel like there's a bit of a double whammy here. So here's an example. You've got Russian airspace, right? They've closed it to over 35 countries at last count. So you've got planes being diverted. You can't go over Russia. Now you got to go around Russia. So it's going to take longer to get from point A to point B. So it's going to take longer to get there. That means it's going to take more fuel. And of course, that means the price of that trip is going to go up. So like cargo flights, for example, you know, so if it's going to cost that much more, maybe we'll take on less cargo. That means fewer items on the plane, fewer items are being delivered, and that adds to the supply shortages. So you get the idea there. There's the auto sector. Again, everyone knows about this, being hit hard by supply problems, and now they're going to get hit again. They're probably going to run short of other materials that they need to build their cars and their trucks. There's like palladium, for example, that's used for exhaust systems in cars. Russia apparently is the largest exporter of palladium. You've got nickel. Russia is also a big exporter of nickel. Some automakers are already closing down some of their factories because they don't have enough parts, because these parts that they're missing are made in Ukraine. And of course, a lot of automakers have also closed their operations in Russia, or they've just stopped selling their vehicles to Russia itself. So, and of course, let's not forget semiconductors. Neon gas, it's imported by U.S. semiconductor makers, and guess where they import it from? Ukraine and Russia. So I don't think I need to go on. You get the idea, but definitely up and up for inflation because of this war.
Great points there, Jennifer. I know we're all really plugged in on the energy going up because we're filling up our cars on the daily, but things such as palladium, nickel, neon gas, what great insights, because these are all, as you said, really going to put upward pressure on that inflation number. Now let's talk about central banks. So with what's going on now and how things are unfolding, where do you see rates going? And I just want to introduce here the data point that I pulled from Bloomberg. So what we're looking at, pre-invasion on February 18th, the market was pricing in, with the US Federal Reserve, so in the US, was pricing in about 6 rate hikes in the next 12 months. Now fast forward to post-invasion, so as of March 1st, we're seeing that number go down slightly, but not by a lot. So now looking just over five rate hikes here, and just a 20 basis point drop between the two time frames. Now this is what the market's pricing in, but Jennifer, what are economists thinking about this?
So we have to remember for central banks, you know, what is their job? What is their mandate? And they're all mandated by price stability, and right now we definitely don't have it. So before February 24th, when Russia actually launched that attack, every major central bank, of course, I'm not going to include the Bank of Japan or the PBOC in there, they were either walking or running, as in the case for like Brazil or Mexico or New Zealand, from their really super highly accommodative stances of the last couple of years. So it became a question of how fast are they going to be tightening and how often. So in terms of how central banks are reacting, I think it's going to depend on what central bank you're looking at. And the toughest and the most uncertain responses, I think, are those that are based in Europe, namely the ECB and the Bank of England. So for the ECB, just very quickly, just back in December, ECB was putting the whole pandemic behind them. They were ending their 1.85 trillion euro PEP, or the Pandemic Emergency Purchase Plan. Then they said they're going to start leaning on their asset purchase plan. And then the market was even anticipating a rate hike as early as this summer, I think. I was actually never ever that optimistic, but I figured a rate hike by year end was quite reasonable. So now this war puts whatever their plans are up in the air. So the question is whether or not the ECB is going to put this normalization on hold and have government step in with fiscal help, because energy prices are already going through the roof and inflation is already at a record high. So I don't think they are going to. I don't think they're going to wait I don't think they're going to wait that long to raise rates. They're not going to rush, but I think a rate hike by the end of the year, I think is still very reasonable, because they are very, very worried about inflation staying higher. That's something that's they've been expecting inflation to sort of level off, but now it's staying higher than they have been expecting. And at their February meeting, they actually said that a scaling back of monetary accommodation should commence. So we're going to have to look for more changes from the ECB. For the Bank of England, similar situation, but they've actually already started raising rates, 15 basis points in December and 25 basis points just in February. And almost half of the Monetary Policy Committee were looking for a 50 basis point rate hike in February. So it was already leaning quite hawkish. Now, if you were guided by the data and only the data, it would totally argue for a more aggressive rate hike by the Bank of England in March. But now even the biggest hawks seem to be getting cold feet. So I think another rate hike in March is coming, although the government might be pressured to delay some of that tax hike. But for the Bank of England, I think a 25 basis point rate hike is quite likely. Now, closer to home, I think the decision is a bit easier. The Fed and the Bank of Canada are still firmly on track to raise rates this year. We basically look for 5 rate hikes in total by each this year, 25 basis points each, but probably more cautiously, just given these, geopolitical events. So starting off with the Bank of Canada, Governor Macklem, he kicked things off already on March 2nd. The bank lifted rates 25 basis points to 0.5%, the first move since 2018, and almost to the day that it started cutting rates back in 2020. I know you don't want to be reminded of 2020, but that's what happened on March 4th and by 50 basis points. But the latest press statement was actually quite hawkish, very worried about inflation, and which the bank expects to be higher in the near term than higher than it is in January. And keep in mind that January we had a 5.1% inflation rate, which is the highest since 1991. They're also worried about the Russian invasion. They're calling it a major new source of uncertainty, and that it's going to push commodity prices and oil prices higher, and that's going to add to inflation around the world. But it did say that it will use its tools to return inflation to target. And the bank's governing council expects interest rates will need to rise further. So I think that's pretty clear what they're going to do. Then there is the Federal Reserve. So up until the invasion of Ukraine, like your chart was showing, markets were betting that there could be a 50 basis point rate hike in March. And there were a lot of Fed rate hikes being priced in. I think it seemed like they're raising the number on a weekly basis, but we were never actually in the 50 basis point rate camp, but we were and we still are looking for 5 rate hikes in total this year. But I don't think that's changed the direction of rates. Fed Chair Powell gave his semi-annual testimony to Congress on March 2nd, and he basically said very plainly that rate hikes were coming. Let me just read from his statement. With inflation well above 2% and a strong labor market, we expect it will be appropriate to raise the target rate for the Fed funds rate at our meeting later this month. I don't think you can get any clearer than that. And then during his Q&A, he specifically said, expect the Fed funds rate to go up in 2 weeks and a series of hikes this year. I don't think any Fed governor has ever been, or Fair Chair has ever been that clear. And he also said that if high inflation persists, he's ready to go 50 basis point at a meeting or meetings. Notice how he used the plural of meeting. So again, super clear what central banks, I think, are, at least these two central banks are planning to do.
Yeah, it sounds like what the market's pricing in and what you're saying, Jennifer, is that monetary tightening is coming, and not much has really impacted that pre-invasion or post-invasion. Now, Jennifer, what about sanctions? So I know these are evolving daily, but where are you seeing the impact of sanctions happening so far as this all plays out?
So the intent of these sanctions obviously is to hurt the Russian economy. You know, there are a number of moves, as you just pointed out, that the world is doing right now. The biggest one, I think, the most attention-grabbing one, was cutting off many banks, not all, but many of them, off of the SWIFT messaging system, or that Society for Worldwide Interbank Financial Communications. And that basically connects that system, the messaging system connects thousands and thousands of banks around the world, and it basically initiates a payment to be made. It sends a message to start the payment process. So it's not a perfect measure to cut them off of the system, but it does make Russian banks, it makes their lives more complicated. You know, they can't get paid for business. They can't pay for the gas that it's sending to Europe, for example. And it also prevents many businesses from dealing with Russia. And that could have, you know, some negative consequences, I think, on some of these global firms and their own banks. But some of the others, sanctions that have been implemented, you know, they're stopping the Bank of Russia from using its reserves to prop up the ruble, which, as I said earlier, has tanked to a record low. Trying to cut off a lot of the wealthy Russians from getting citizenship elsewhere, you know, if they promise some big investments. They're stopping all sorts of trade and sales of things like cars and iPhones and other luxury items to the country. Even Germany, you know, surprisingly stopped the process for certifying the Nord Stream 2 gas pipeline. So basically just trying to cut Putin off from the world as much as possible. So far, energy, I think, has been avoided, has not been sanctioned, although the U.S. is saying that it is on the table. But there's also the indirect impact of these sanctions on the rest of the world, and basically the world economy will probably get hurt in the process. Some of it was actually quite immediate. You know, financial markets were turned upside down, so there's a lot of turmoil right away, a lot of volatility with equity prices soaring and energy prices soaring and equity markets selling off. There's an indirect channel, you know, the consequences of the SWIFT ban, but overall, this sanctions themselves, I think they are a very complicated and a highly delicate process. And I don't think I'd be surprised if, you know, you find out that a lot of companies are probably not sure exactly what is involved or what they're supposed to do, or, you know, if you work at a port, you know, are you allowed certain goods to start coming in, or are they exempt? You know, are they heading in or heading out? So not sure if that is completely clear, but definitely the impact of sanctions is meant to hurt the Russian economy, and I think that it's already taking place right now.
Yeah, I think the market is definitely still sorting out how these sanctions are going to impact each company, each industry, and like you mentioned, just a lot of volatility right now we're seeing in markets as they sort this side of this whole equation out. Now, Chris, I really want to turn to you on this data, and we got this from our friends at National Bank, and I think this is really, really interesting as we look back on how the stock market has historically reacted to wars. We have data going all the way back to the invasion of Poland in 1939 up until the most recent of around 2014 when Russia occupied Crimea. So tell us what this kind of says about how historically markets have reacted to invasions and wars.
Certainly, Danielle, and as you say, you know, we got a variety of different incursions that have taken place over history on this chart here, and there's two parts to it. So the first couple columns, the first few columns, shows what the market performance was, you know, in the weeks and months heading into the incursion or the event in question. And then the last few columns show what the market, and this is the S&P 500, how it performed following the event. And generally what we see here is there's a bit of market weakness leading up to the incursion or the event. And so I think typically these things don't come out of nowhere, right? There's some expectation, and we saw it even in the most recent example here with Russia invading Ukraine, with the US in particular and the UK, coming out and warning of this impending invasion. And again, investors and citizens globally really had an idea that this was coming. And so that starts to get priced into the market before the event actually occurs. And so, 3 months before the event, you can see, and 1 month before the event, on average, the market is actually down a little bit. And then what we see going through the event, the immediate weeks and months to follow, we have that continued volatility, and that's what we're going through right now in the market. That's what we're experiencing right now. A little bit of mixed returns, continued volatility as the market continues to try to assess the impact of these invasions and of these events through history. But I think what you see that's most important here is as you start to zoom out into the longer term, 3 months and indeed 12 months and beyond the event, market returns are generally, what you would expect in normal market conditions. We see an average market return over the 12 months of 7.7% with a median of 9.7. So, kind of high single digits moving into the double digit returns, about 3/4 of the time, being positive. And so that's not really too far off of the normal distribution we would see when you're looking out, 12 months, what is the market going to look like? So I think this is telling us really, again, that, there's tends to be some volatility around these events, but in the long run, the market returns will be driven by the major economic factors that typically impact the market. So, if you really think about this, even if this situation drags on a lot, particularly consumer staple stocks and things like that, people are still going to go to Costco. They're still going to, buy what they need to buy, those consumer staples. They're still going to go to work. So that part of the economy still continues on. And that's, again, the major driver of market returns. I think, what Jennifer was talking about previously about central banks raising interest rates, the pace of interest rate increases, in the long run, that's going to have a larger effect on market valuations, more than likely. Now, I would say in this particular case, of course, these events aren't all the same going through history. And what's unique about this one is, I think, the level of sanctions that we've seen being placed on Russia, really unprecedented. And Jennifer got into what some of those were. But really, that's something we haven't seen yet, when it comes to these sorts of events. And so judging the impact of those sanctions and if there will be any, spillover effects into other parts of the global economy is a little bit hard to tell right now. So that's one area where, this could potentially impact global markets, US and Canadian equity markets a little bit more than in the past. And certainly the opportunity for certain sectors to be affected. And we've talked about energy prices already a little bit and some of those agriculture and other resources being impacted by this. That could have some spillover effect into sectors of North American and global economy. And then, that can have knock-on effects as well. If inflation is running too hot for too long, that might impact consumer discretionary spending and like. So that's probably the one area here where this might be a little bit different than what we've seen in some of the other incursions in the past, where you could start to see a little bit of spillover simply because of the unprecedented nature of where we are right now.
Thanks, Chris. And I will just add, so these numbers here are showing the S&P 500 performance. So that's the proxy in this example, showing how it's reacted to wars historically. Of course, local markets or markets in regions or countries that are closer to these events, it would probably have a little larger impact. So Chris, as we move on, volatility is something we've been talking about almost weekly, it seems like. What can you tell us about the historical analysis of volatility and market performance?
Sure, and we have a couple of different charts here, and one of them, both of them really referencing the VIX. So for investors that might not be aware, I think a lot of people hear the VIX being referred to in market commentary, but just to clarify what the VIX actually means. It's the market's expectation for the volatility of the S&P 500 in the coming 30 days. So the higher the number, the more uncertainty there is in the market and the greater likelihood of expected outcomes. And that's really what the chart on the left is showing us, is that when the VIX is low, below 12, that's a fairly certain market environment, and the market does not move very much from day to day. You can see the majority of instances here happening right around that zero, just a slightly positive return over that 30 days. And so again, when the VIX is relatively low, you can expect pretty low market movement in the coming month. Then when the VIX gets a little bit higher, it's above 12, but below 30, which we would call a very elevated level. So when it's in that middle range, you can see again that peak is lower and the variety of outcomes is spread out a little bit more. So, when the VIX is, call it 25, there's a bit more uncertainty as to where we're going to be a month from now. And you can see the actual outcomes mirror that. And then of course, when the VIX is above 30, there's significant uncertainty in the market. Markets could go up significantly, they could go down significantly. So again, I think it's important to remember, high VIX, a high level of uncertainty, it doesn't mean the market's going down, it just means we don't know which way the market's going. It could go up just as much as it could go down, but the degree to which that moves is elevated when the VIX is that high. And so what does that mean for investors? When you're taking a look at your portfolio, when you're trying to invest, when you're buying or selling and making those decisions, the level of uncertainty in the market will affect potentially that average bid-ask spread that would be on any ETF or any traded stock or even fixed income. Really, typically what you see, and this is the chart on the right-hand side, is you'll see those spreads widen out a little bit. And I think that makes sense because, again, there's just more uncertainty in the market, not just as to where prices are moving going forward, but also what's the current value of these prices. Is it changing? How quickly is it changing? And so, as an investor, when you look to buy or sell a security, whether that's an ETF or a stock or even a fixed income holding or preferred share, when you enter into that market, when in higher volatility periods, you can expect to pay probably a little bit more on the bid-ask spread. So if you're buying something, you might have to pay an extra penny to buy it, or if you're selling something, you might have to accept one less penny to sell it, so to speak, or 2 pennies or what have you. But that's essentially what's going to happen. So it's really, impacting the cost of trading for investors. And so I think it's just something to take into account before you act. We're in a bit more uncertain time. And if you want to make that trade, you just want to be certain about it and just accept the fact that, there's a possibility you might have to, pay up a little bit to transact in this market environment.
Chris, I love what you said there. I'm going to highlight again about looking at volatility and reading volatility. High volatility in the VIX or what have you, it doesn't mean, it's not a prediction that the market is going down, but rather it's more of an indicator we actually don't know where the market is going. And last week, as we saw the first few days of this all play out, this was exactly what happened. We woke up on Thursday morning, we saw that this war had begun, markets were down, and then Friday morning we look at markets, things are up, which was a surprise, I think, to a lot of investors. So increased volatility doesn't always mean that markets are going down. It means we really don't know what direction each day they will be going. So here is a asset class, Chris, that is very impacted by the events that are unfolding, and that's emerging market equities. And because Russia and the Ukraine for that matter, are both emerging market economies, we're seeing a lot play out. We're getting a lot of information today about a lot of emerging market indices and what their treatment of Russian equities will be. Chris, what is the impact on this asset class, and can you give us a rundown on where Russian equities stand in terms of the ETFs that may hold them?
Yeah, certainly. Again, this is something that really, where we've got to is, I would say, almost unprecedented, especially in terms of how quickly this has happened. For investors in emerging markets, and certainly I think a lot of people are, at least for that growth element. We always suggest a diversified portfolio of which, emerging markets would be part of that allocation. Just taking a look at BMO's ETF here, ZEM, that mirrors the MSCI Emerging Markets Index. Before the invasion, Russian equities were about 3.5% of the Emerging Markets Index, and so not a huge amount, and probably a good thing just because of the impact that we've seen on these Russian equities. But really, what we have seen, because of the sanctions, because of all the things happening, and the fact that the Russian stock market actually hasn't opened since February 25th, we've seen index providers now take the step, and some of them have announced that they'll take the step to remove Russian stocks from the emerging market index. MSCI in particular has specifically said that they will reclassify Russia from an emerging market to a standalone market. And so really, again, what that means is it's no longer in the emerging markets index, or it won't be as of March 9th, which is the date MSCI indicated they would remove Russia from the emerging markets index. Now, there's a few things that go into that. Primarily, of course, is the investability of that market. The market is closed. You can't invest in it. You can't buy. You can't sell. The Russian central bank also placed a ban on foreigners selling Russian equities, and so, and then of course, again, with central banks being sanctioned, with the removal from the SWIFT system, even if the market was open and you were able to trade one of these equities, you might not be able to pay for it or get your money back. And so the investability of the Russian stock market as of now is no longer. And so MSCI, and again, other index providers as well, have taken the steps to remove all Russian securities essentially at a zero price. And so it's almost as if, it's no longer in the index. That 3.5% essentially will be gone and will be no longer in the index. Now, for investment products like ZEM, like the emerging markets ETF, and others that are like it that hold Russian stocks, these portfolios will still hold those equities, but it's unclear as to when or if they'll be able to dispose of them, and at what price you'd be able to dispose of them at as well. So that's still to be determined. And again, I think it'll depend on the length of time this incursion takes place, the length of time sanctions are in place, and all of that. And so, it will be some period of time before that will all get taken out. And then at some point, you would assume the index providers would again review the Russian stock market, and potentially at some point place that back into the index if they determine it becomes investable again and it meets all the other criteria of capital flows and what have you. So very interesting situation here. But essentially that's how index providers are handling it right now. And I'm sure we'll hear further announcements from other index providers in the near future.
Yeah, really interesting. Thanks for breaking that down for us, Chris. I've never seen a country being eliminated from an emerging market ETF or index in my investment career. So I'm learning as I go as well. I was reading this morning that there's about $300 million within Canadian listed ETFs that are holding Russian securities. So if you think about the market here in Canada on a whole, that's a very small amount. And there's no standalone Russian ETFs listed in Canada, but some down in the US. There are a few trading there. Now let's switch to an asset class that we're very familiar with, Canadian equities. Now, Jennifer, I'd like you to set the stage here and let us know, has this invasion or has this war impacted the outlook on Canadian growth?
Okay, let me, if you don't mind, I'm just going to take that back one step up and just look at global growth in general. Obviously, this is clearly negative. We've actually downgraded our call for global growth to about 3.5% this year. 4% this year and 3.5% next year. Again, it's been clearly negative, and you've felt it immediately through either financial spillovers or commodity prices. Because Russia's like the main supplier of energy to Europe, and prices have soared. So, and there's fear in Europe that Russia is going to turn off the taps for natural gas, even though gas has continued to flow. It hasn't been interrupted, but futures prices are still, running well north. And of course, there's all the supply problems that I've already talked about with aerospace, with the airspace being closed off and all that. Now for Canada, we are going to get hit by the same factors, all the same financial stresses and the uncertainty over sanctions. But we are a big energy and food exporter. So that will help us, that will help cushion us, our economy in the face of all of these, this steep run up in commodity prices. But you've got surging energy prices, and that's good news for provincial coffers, but it's definitely going to help or hurt consumer spending. Overall, we still remain quite constructive on our outlook for the Canadian economy. It was up a solid 4.6% in 2021. We just got the data the other day, and we're looking for 4%, a little bit of a slowdown to 4% in 2022, and about 3.5% next year, which is still quite decent. But obviously, this is going to have a negative impact, and especially in the inflation front, which is, as I said earlier, is going to keep the Bank of Canada raising rates steadily.
So, Chris, now what is your perspective here, more from the bottom-up perspective? How are Canadian equities going to stand? Will they benefit if these sanctions increase on Russia and buyers need to come to Canada for materials that they were getting from Russia?
Yeah, it's certainly a balancing act. To some degree, you're right. I think Canada may be a beneficiary to some degree of what's going on, but again, inflation impacts the consumer as well and could sort of tip over the other way as well. If you take a look at this slide, on the right hand side, the sectors that make up the Canadian economy, of course, we know financials is the top. But the next three sectors, energy, industrial, and materials, that's about 40% of the TSX index. And, those are the sectors that are going to benefit from what we're talking about. Of course, the energy sector with very high oil prices where we see them right now in gas prices, that sector should benefit from that. And materials as well. We've talked about nickel and some of the other resources that are also in demand and also driving inflation. These are the sectors that will benefit from that. And then, of course, industrials, to a large degree, involve servicing some of these industries and also moving these goods and these commodities around, right? So railroads and things like that. So you have about 40% of the Canadian economy or the Canadian index here that should benefit from rising levels of commodities, of energy, and of economic activity. So again, this is where that tipping point might come in. If economic activity slows down to some degree, that will hurt some of these areas as well if it kind of goes too far. And then the largest sector, financials, banks and insurance largely, actually looks like a pretty strong sector as well in the face of what Jennifer was just describing as the rising interest rates. That is all but certain to come through the market in both Canada and the US through 2022 and most likely to some degree through 2023 as well. So, a value-oriented sector that pays a pretty strong dividend that relies less on growth is going to benefit in that environment, and that's what we think banks and financials are set up very well to do. So overall, I think the Canadian market, in terms of the sectors we're exposed to, could perform fairly well in this type of market environment. But again, with too much economic slowdown, of course, that hurts consumers. That could potentially hurt anyone. So that's the risk that's out there.
Now, Chris, let's talk a little bit more about the energy sector. You pulled this for me this week. So this is WTI prices on the rise. We all know it. We see it at the gas pumps. But then right after that invasion is announced, they skyrocket even more. What has the impact been on energy, and then maybe specifically the Canadian energy sector?
Yeah, so WTI oil is West Texas Intermediate. That's sort of the benchmark for North American oil prices. In Canada, we generally do tend to trade, the companies do tend to trade at a different price, but highly correlated to WTI. And so, when you think about, most energy markets are somewhat regional, but when we're talking about the risk of Russia cutting off Europe and North America trying to help out Europe, supplies potentially being moved around, whether that's LNG or whether that's oil or what have you, to the degree it can be moved. To some degree, what's happening in Europe is going to affect the North American markets. And that's what you see in this chart here, is that price really taking off. And so again, Canadian energy companies should benefit from that. To some degree, they have their price contracts already sort of locked up for the foreseeable future, or at least some percentage of those contracts are locked in for the foreseeable future. But when they come for renegotiation, they can be locked in at higher prices should the price stay where it is. We should note that the highest we've seen in WTI, well, it was over $100, was actually much higher, closer around $130 is where it was, $140 before the 2008 financial crisis. And so, even though oil has spiked and we're over $100 here, there is potential for it to move materially higher as well if this situation drags on, if there are disruptions to other oil and gas markets. And so, I think, again, Canadian producers should benefit from this. They have that higher price, and it could potentially lead to higher volumes for them as well.
Now, another resource or material that we have our pulse on is gold, which has historically been a go-to asset class in times of geopolitical unrest and increased volatility. What's the outlook, Chris, for gold, and what have you seen for this asset class recently?
Yeah, there's two primary investment cases to invest in physical gold, and one of them is as an inflation protection. And when we saw mass amounts of stimulus flooding the markets, gold price did well in that, or sort of leading up to that, as that inflation hedge. Now that inflation's actually coming through, we didn't see the gold price actually move that much anymore. And so a lot of that was actually already baked in. So for those looking to gold as an inflation hedge, it hasn't really moved much in recent periods before this, simply because it did move up quite a bit prior to that. And so the market somewhat looking ahead and getting into gold for that inflation hedge. And then as inflation's coming, not really reacting. So it hasn't really worked as an inflation hedge in call it the last year or so. However, the other sort of rationale for investing in gold is as a safe haven, is in times of crisis. And that's what we're seeing right now. Gold not too long ago trading at $1,800 an ounce, now over $1,900 an ounce. And so, really actually fulfilling that objective of being that store of value, that safe haven investment. It looks like, there was some question as to if investors were doing that anymore, were considering gold that safe haven anymore, if it was some other asset class. But it looks like gold actually working as that safe haven. Investors, when they're uncertain, have moved to gold, and we see that, kind of bouncing around in the low 1900s right now. We've seen some calls for it to go above 2000 again, but really holding its own in terms of, again, that safe haven and that flight to safety.
Thanks, Chris, for talking us through that. Now, I put a couple slides here just to give our audience some information what to expect from ETFs, so those who are using ETFs in their portfolios in times like this. So Chris mentioned this kind of earlier in our discussion, but there will be wider bid offer spreads. That's to be expected, especially on those emerging market ETFs or perhaps the international equities. So that is something that can play out as we see volatility increase. But what ETFs also do is they provide that ongoing liquidity. So even in a time of crisis, and ETFs have proven this time and time again, if we look back on the last kind of market volatility that we saw when COVID hit in March 2020, ETFs continued to trade and they continue to provide liquidity for investors. That is the power of an ETF. Now, I also want to remind investors a few trading tips when using ETFs. We always say avoid trading on the open and close of the market. I can't think of a better example than what's going on now. Every morning when we wake up, there's a new headline, there's a new development. And when Canadian markets open, they need to digest all that information, and that might take 30 minutes for that to get sorted and for prices to settle down or settle in. So just avoid the first 30 minutes if you can of the day and the last 30 minutes. Use limit orders. We tell investors this is good advice because you have no surprises as to the price you're going to pay for a security or you'll get for a security if you're selling. When you set a limit order, you know exactly the price you'll get if it goes through. So that helps in times of volatility. Try to trade when the underlying market is open. So if you're looking at international equities, that would be in the morning here in Canada and in North America. I know this isn't always the case. This is hard to do sometimes depending on what market you're looking at, but this definitely helps, especially keeping those bid-offer spreads a little bit tighter. And just awareness of market volatility. So during times of high market volatility, those bid-ask spreads can get wider. That's to be expected. Now, we do have a lot of questions. We'd love to get to them. Thank you so much for sending them in. Our first one about gold ETFs. Chris, I'm going to throw this to you. How can I use an ETF to get exposure to the price of gold in this environment? And is there a difference between investing in gold equities or gold bullion?
Yeah, there's a variety of ETFs for investors that are interested in gold. Maybe I'll tackle the second part of that question first. So what's the difference between a gold equity ETF and gold bullion ETF? So a gold bullion ETF will go out and purchase physical gold and hold it in a safe for all the investors that are in that fund. So when you go and buy that ETF, and there's a couple that trade in Canada, there's a few that trade in the US as well. If you buy that ETF and you buy $100 of that ETF will turn around and buy $100 worth of gold, the actual metal, and put it in a safe. And so that's what you're buying when you buy a gold bullion ETF. And so that will go up and down in value as the price of that bar of gold will go up and down in value. The only other thing to think about there is storage costs and things like that. So there are a few differences among ETFs from there. So a couple of things to look into. Again, there are a few options for investors to look at. And so that's a gold bullion ETF. When you're talking about investing in gold-related equities, in this case, you're buying the stocks of companies that go out and dig for gold and produce that gold. So the companies that are digging that gold out of the ground and putting it into that gold bar form, if you think about it that way, or into other use cases of gold. So in that case, what you're exposed to is the companies that are invested in the gold industry, and therefore there's a potential for a higher return because these companies tend to be leveraged to the price of gold. And if gold goes up in price, their revenue can go up significantly while their costs are somewhat stable. So, that's the benefit of investing in gold equities, is that you can get a much higher return potential. You don't actually need, the bar of gold to go up too much for you to get a nice return on investment there. Of course, the risk is that there's an execution risk involved there. There's, some companies are digging for gold. Maybe they don't find any, or maybe it comes out and it's more expensive than what they thought it would be. So there's an execution risk on the management of those companies that you're taking on in order to buy that gold equity ETF and get that upside return potential. So those are the two different ways to invest in gold. At BMO, we offer those gold equity related ETFs. ZGD is the sort of large cap gold providers, and ZJG is the junior gold, or the smaller cap gold producers. So two options for gold related equities. And as I mentioned, there are several options for gold bullion, both in Canada and the US.
Thanks, Chris. Thanks for the question. Okay, this is a popular one. Chris, can you briefly explain the difference between a market cap weighted ETF and an equal weight ETF?
Sure, yeah. So a market cap ETF will will weight the securities in the index or in the portfolio according to the size of the company. And so, using Apple as an example, as the largest company right now in terms of the highest market cap, a market cap ETF would have Apple, if you're looking at the US market, would have Apple as the highest weight in the portfolio. It's right around 6-7% right now. It does move over time. It's hard to keep track of. And then each company would have a lower weight beyond that, again, as each company has a smaller market cap. And so the weight would be tied to that. An equal weight ETF is exactly as it sounds. Every company in the portfolio gets an equal weighting. So Apple would get the same weight as a small cap company or what have you, or any other company in the index or in the ETF. So what you're getting is an equal exposure to all companies in an equal weighted ETF, no matter the size. And so you'll tend to have a small cap bias when you invest in an equal weight ETF relative to a market cap ETF, because you'll have a higher weight in those smaller names than what a market cap ETF would.
Thanks, Chris. And we do tend to see equal weight more on the sector ETF side, because these are the types of ETFs that have less amount of names, and oftentimes one or two names will dominate if they're market cap weighted. So something to look for, especially when you're looking at sector ETFs. This investor wants to know what type of ETF would be exposed to the rising price of oil. Chris, I think you already did a great job touching on this earlier. We talked about the energy sector as an example. An energy ETF like BMO's ZEO is full of energy producers, and these companies will be beneficiaries of the rising price of oil. Our last question. So does ZEB, this is the BMO Equal Weight Banks Index ETF, does it pay dividends like the individual bank holdings, and how frequently does this occur? I pulled this right from our website to help answer this question. So the banks pay their dividends quarterly, but we set ZEB up to pay out distributions monthly. So an added benefit for those investors that are looking for monthly distributions coming out of those bank stocks. We did see an increase in bank dividends that happened at the end of 2021. That has flowed through to the ETF. So whereas last year we were paying out 10 cents a share monthly, we're now paying out 12 cents per share monthly. You can find all this information BMOETFs.com under the tax and distribution section for each ETF. You can look at the payment schedule and how much is getting paid out at each payment period. So thank you so much for the question. What a great conversation today. Thank you so much to Jennifer and to Chris for their insight and their expertise as we try to unravel everything that's happened over the last week. I do want to highlight something that BMO, we did as a company just at the beginning of the week, actually. We donated $200,000 to the Canadian Red Cross Ukraine Humanitarian Crisis Appeal, which is supporting humanitarian needs related to the situation in Ukraine. So I wanted to report that. Thanks so much for tuning in. Next week, we'll be back. We'll be talking about international equities. How are these different from North American equities? What's the opportunity here? So please tune in. And if you'd like more content, check out our YouTube channel and click subscribe. It really helps us grow the channel and grow our content. We'll see you next week.
Thank you for watching the Market Insights webinar series. To stream any previous episode of the Market Insights webinar series, please visit www.youtube.com/ETF Market Insights. Remember to hit subscribe so you know when we post new content. Also, we invite you to visit our accompanying website for ETF tools, education, and much more at www.etfmarketinsights.com. Once again, thank you for watching. The session provided is for information purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or a recommendation to buy or sell. Particular investments and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to any circumstance.